What if the very system designed to protect your money was the one that let it slip away? That's the claim New York's Attorney General is making against Zelle, the popular digital payment platform, in a lawsuit alleging that lax security measures led to over $1 billion in consumer fraud. Letitia James, the state's top legal officer, is accusing Zelle of ignoring basic safeguards for years, leaving users vulnerable to scams that drained their accounts. And here's where it gets controversial. Zelle's parent company, owned by banking giants like Bank of America, Chase, and Wells Fargo, is pushing back, calling the lawsuit a political stunt. But who's really at fault when fraud strikes? Let's break it down. Zelle, launched in 2017, competes with apps like PayPal's Venmo and Block's Cash App. Its parent, Early Warning Services, is a joint venture of 7 major U.S. banks. James argues that these institutions knew for years about Zelle's security flaws but failed to act. For example, she cites cases where users were tricked into sending money for fake utility bills or non-existent puppies. One victim was told their electricity would be cut off unless they paid $1,477 via Zelle to a phony account named Cone Billing. Another lost $2,600 after sending money for a puppy that never arrived. Zelle's response? The company insists the blame lies with users who fall for scams, not with the platform itself. But is that fair? After all, Zelle markets itself as a safe alternative to cash and checks, backed by the banks. So where's the responsibility when the system fails? James claims the turning point came in 2023, when the Consumer Financial Protection Bureau, CFPB, and Congress started investigating Zelle's practices. Only then did the company implement basic anti-fraud measures it had proposed 4 years earlier. While fraud rates dropped afterward, James argues the changes were too little, too late, for victims who'd already lost money. Zelle, meanwhile, boasts that 99.95% of its transactions are fraud-free and accuses the lawsuit of prioritizing headlines over facts. But here's the catch. Even with those safeguards, the complaint alleges Zelle still enables substantial fraudulent activity. Could this be a case of corporate accountability versus free market innovation? The lawsuit demands Zelle strengthen its security protocols and reimburse affected New Yorkers. This isn't the first time James has taken on financial institutions. She previously sued Capital One over alleged interest rate abuses and settled a case against MoneyGram for remittance errors. The CFPB, which dropped a similar case against Zelle earlier this year, has been criticized for scaling back enforcement under the Trump administration. Does this shift in regulatory focus explain why Zelle's defenses have been so aggressive? So, what do you think? Should payment platforms like Zelle be held legally responsible for fraud when users are the ones being deceived? Or is this just another example of regulators overreaching into the tech sector? Drop your thoughts in the comments. Let's start a conversation about who truly owns the risk when money moves online.